Welcome to Forex 101, the guide which will tell you exactly what the Forex market is, why we trade Forex, how we can profit from trading, and Forex in particular, and of course chart basics. And this is certainly good for you if you're brand new to trading and you want to know exactly how we could use trading in the financial markets as a vehicle to getting a good potential capital growth. So what is the Forex market first and foremost? Well, the Forex market is essentially a decentralized marketplace where currencies are traded amongst the banks, institutions, private investors, hedge funds, pension funds, you name it. But unlike most markets, like for example the FTSE or the Dow, there's no centralized marketplace for it. And essentially it is a decentralized marketplace where people are able to buy and sell different currencies. Of course, you get currencies which we call the majors, which are listed against the US dollar, the minors, and of course the cross-currency pairs, which are almost triangulated currencies. Say, for example, currencies which aren't paired against the US dollar. For example, Euro New Zealand, or Aussie Swiss, or Pound New Zealand. But in terms of just looking at currencies on their own, just like with stocks, the more buyers a currency has, the higher it will go against the currency it's termed with. Essentially, if we see a pair, and you won't see a currency on its own, but you'll generally see a currency paired up with another one, for example, euro-dollar, it's essentially a two-horse race between the euro and the US dollar as to who has the most sentiment, who has the most confidence, who's buying more than selling more. For example, if people are buying more euro than the US dollar, then the euro will rise in value compared to the US dollar. If the euro has more sellers than buyers, it will fall in value against the US dollar. And it's the same again with any other currency pair out there, whether it's Euro Swiss, Euro New Zealand, Euro Sterling. It's a two-horse race essentially between two currencies. Which one has the most buyers? Which one has the most sellers? The one which has the most buyers, or more people buying it, will rise in value compared to the one it's paired against. Suffice us to say, if the euro has more buyers than the US dollar, it is said to be strengthening against the US dollar, and the US dollar is simultaneously weakening against the euro. If the euro is up against the US dollar, it's known as euro strength, and if it's the other way around, if say for example the euro is falling against the US dollar, we can say that the US dollar is strengthening whilst the euro is weakening. And this is known as dollar strength, and this typically happens when there's a risk off sentiment in the market, and that's where people are starting to sell stocks and buying fixed interest rate securities, and of course safe haven assets like the US dollar, for example. So the currency markets are news driven, as is any market for that matter, and very sensitive to news announcements. And we've got the example here. Say if the Bank of England decided to announce that the interest rates would rise in Great Britain, that will cause a spike in the British pound. Because if interest rates rise, then that would be a much better return for people who invest in the British pound than they would otherwise get, say if they were invested in a currency which had a less high interest rate. Of course, at the time of doing this video, the interest rates are rock bottom, so if they are increased, then that will suddenly cause an excitement. The pound will invariably go up against the US dollar because investors will get a much better return on their money. And of course, currencies with regards to the news ebb and flow. It's just like a river or a stream down the hill. They'll ebb and flow in the pathway of the least resistance. And news perpetuates moves. And of course, as traders, we only want to trade if there's a technical opportunity to do so, according to our strategy. We do not want to try and guess the news as to what it is by jumping in a market, thinking and hoping. That's what amateurs do. That's why amateurs lose a lot of money and then don't go back to it. But as you might have heard before, the daily time frame which we trade is immune to most news and announcements, which is why we trade it, quite frankly. We don't want to have small fry like news getting in the way of our lovely trades. Why would we? Okay, so in terms of currencies which we trade pretty much every currency there is. I mean, it's just a chart after all. It doesn't really matter what the currency pair happens to be. It's just a chart. We trade what we see, not what we think. And we've got the majors here, generally paired up straight with the dollar. We've got euro dollar, dollar yen, cable, Aussie dollar, Swissy, or dollar Swiss, and dollar CAD, affectionately known as the loonie to some people. And we've got the cross rates, which essentially do not involve the US dollar. They're triangulated currencies. So we've got, say, for example, euro against the rand, euro yen, euro New Zealand, euro Aussie, euro CAD. You get the gist. Anything that basically is paired up that doesn't include the US dollar. So the great thing about the currency markets is that they're just simply so liquid. If $4.5 trillion trading on a daily basis enables it to be resilient to manipulation like you'd get in smaller markets, for example. It would cost a bank something like $9 billion to move, say, for example, euro dollar, 5 pips apparently, and no bank can afford that, certainly at the moment. So given that currencies move hundreds of pips every day, it makes the currency market very resilient to this form of manipulation, which is fantastic. It means that it's a level playing field for everyone to trade potentially, providing they've got a strategy, that is. So when we look at currencies and their prices, the officially quoted rate is known as the spot price. And of course, if we look at the broker platform, as and when we go to place our trade, we'll always be looking at the difference between the buy and the sell price. And the difference between the buy and the sell price is known as the spread. And this is essentially the broker's small haul charge or commission per trade you place. Say, for example, we're looking to sell euro dollar, and the buy and the sell price, respectively, is 1.3612 and 1.3614. Then we can say the difference is 2 pips. So we'll be paying essentially what our stake size is times the difference in pips between buy and sell. And that would be the little charge which you have to pay for the trade. But as a general rule, and we don't worry about this charge, it's not essentially the most liquid the instrument, the less the spread or the charge is going to be. So typically for the major currencies like euro dollar, cable, Aussie dollar, the spreads would be a lot lower than if you're trading some of the more exotic pairs, like for example, the Swedish krona, which are a bit less liquid, or should I say a lot less liquid than the majors. But of course, as with anything, just like in a supermarket, it makes sense to go with the broker who has the most competitive spread or the smallest spread, because if they have the smallest spread, that's like you'll be saving yourself money in the long term, without a shadow of a doubt. So just to sum up why we actually trade Forex here, there are numerous reasons, absolutely numerous reasons. It's open 24 hours a day, 5 days a week. It's volatile and fast moving, so we can potentially make money and percentage return far quicker. And if we're the wrong side of the trade, then at least we're proven wrong and we can move on to the next trade in a quicker or faster amount of time. It's the most liquid market in the world, which is fantastic because it makes it less susceptible to insider dealing, gapping, manipulation, you name it. It's not there on the currencies, fortunately. The barriers to entry to trade are extremely low. Unlike with stocks, you could start off trading with as little as £1,000 or $1,000 in your trading account. Unlike with stocks, where to get any meaningful gain, if you're just buying and holding stocks, you need at least 5,000. But with currency trading, spread trading, it's highly leveraged, so you can make more money from less, essentially. And you could essentially control £500,000 with just £5,000 with a leveraged account of 100 to 1. What happens is the broker gives you the leverage of 100 to 1 so that you can essentially control the equivalent of 100,000 with a £1,000 trading account. And this is extremely advantageous because it means you can make more money from less. And also, with the currency markets, we can find opportunities time and again, making money as the markets go up and go down, or even if they're moving sideways, we can still find ways to make money. It's extremely versatile, rather than, again, the traditional buy and hold share options, where you can just simply only make money as they go up. With currencies, we can make money as the markets fall, and that's great because when markets fall, they really do fall very quickly. Suffice it to say, the bull climbs up the stairs, the bear falls out the window, and if we can make money from the bear as he falls out the window, then absolutely fantastic. We can essentially make faster returns. So when it comes to the very basics of the charts, a red bar is essentially a seller bar as far as the interesting norm is concerned. You won't always see this on the charts, by the way, but as a general rule, a green bar equals a buyer bar, and a red bar equals a seller bar. And essentially, to quantify a buyer bar is classified as a buyer bar if the close of it is higher or at a higher price than where it is opened, or where it has opened. And suffice to say, to quantify a seller bar, it's only a seller bar if it closes at a lower price to where it opened. And we can get two forms of bar here. We've got candlesticks and OHLC bars, or open, high, low, close. And again, same principles. A buyer bar or a buyer OHLC bar closes at a higher price than where it's opened, and for a seller OHLC bar, it closes at a lower price to where it opened. And essentially the same mechanism behind these bars, but they're just different visually. That's the only difference, and you just need to choose something which works best for you. We personally use candlesticks, but some people use OHLC bars, and they trade just as well with them. So how do we make money from currencies? Well, you'd be glad to know this is quite a simple process. All you need to do is go long, to speculate the market is going to go up, and if it does go up, then you're rewarded by however many pips it goes in your favor, times however much you've bet for your stake size. And if you decided that it's going to go short, and the market goes south, you get rewarded however many pips it goes in your favor, times your stake size. So long is if you're bullish and you're looking to buy, and bearish is when potentially the market's looking to go south, you're looking to sell, and it's that simple. But remember, we can make money from currencies as they both go up and down. It's a two-way street. And when we say pip, by the way, a pip is essentially the smallest increment where a currency can move. It's essentially a 1/100th of a cent, and it's the smallest price change that any given exchange rate can make. And this is what we trade, essentially, the pip movement. And we can get hundreds of pips movement in a day for currencies which are slightly more volatile, like, for example, the British pound against the dollar, cable. But just to give you an example here, let's go back to our trusty friend, euro-dollar. And it falls in value. Say, for example, there's been another debt crisis, and it fell suddenly by 100 pips. And we happened to be short anyway, based on the technical setup, and we had a stake of £10 per pip, and it did actually go our way. Then, well, we've made a cool £1,000, because it's gone 100 pips in our favour, times by our stake size, which we've already worked out of our broker, which will be 1% of our account. And yeah, we've made the amount of money which we wanted it to, as it's hit our target. And just to give you another example, for example, if we did decide to place another trade, and £10 again per pip, and it made a 20 pip move, say for example, short, then we've made £200. Simple. But as you'll discover in the next module, risk management, we need to assess the downside of any trading decision, and that's very important. This is where 92% of people who fail, this is what they get wrong, essentially. And just to give you a preview, you should risk no more than 1% of your trading account per trade, and you should always use a stop loss, because you do not want to wipe out your whole account if the trade moves against you. And this is one of the key things that separate the profitable pros to the complete amateurs. And this is just an example of how we can profit from rising markets. This is the, Aussie Swiss. We've entered at this level here, and we've exited at the 50 moving average, just in advance of the previous swing high. We made 307 pips profit, and we had a stake size of £15 per pip, and this has given us a profit of £4,605. Not a bad profit, hey? And in this case, we've got Euro Yen. We've sold at this horizontal level, 11600, and we've exited about 146 pips away, and our stake size is £10, so we've made 146 pips times 10, 1,460. Not bad, hey? Anyway, read on to the next module, risk management. We wish you well, happy trading,